Here we are. So, ladies and gentlemen, good morning, or I would say good lunch, in fact. So, thank you for welcoming. I'm very honored because I'm the first non-Greek speaker, and I've been working with Greece for all these years, but it was always difficult to pick up the language. Even I do remember 10 years ago, I was attending your conference, and I promised, unfortunately, to learn Greek. So let me start by introducing myself. So my name is Chevalier. As it has been said, I'm a partner at Ernst & Young, leading the pension advisory services. So I'm a specialist in economic studies, but I'm also an actuary, and so for that reason, I'm fully aware of the pension industry issues. So first of all, and it has been said very clearly by our president, Mrs. Andonacchio, our pension systems all in Europe are in danger. They are in danger due to the longevity issues. They are also in danger because most of them, and it has been just reminded, are pay-as-you-go systems. And pay-as-you-go systems are very beneficial if we have growth, if we have growth in also population. And it was a perfect system for the past 40, 50 years. It's a wealthy system sometimes. It provides a very, very high pension and not sufficient reserves in the accounts of the pension public system. So maybe I'm not going to spend so much time on what has been already be presented. The only thing I would like to remind is that in our aging and social welfare system, pension is one of the components of a coverage that is necessary to provide to our aging population. But this is not the only one. Health has been reminded as being very important. And this is the same kind of issues because it deals also with longevity, with long-term care system. Housing, apparently it's not an issue for Greece. But also well-being is something very important because more and more, I would say, European people are living longer in good health. And they don't want to be, I would say, let without doing anything. So the three pillars, as described in all the OECD publication, are very clear to everybody. Our pension system should provide a philosophy, a mission, a vision, objectives, which are very essential because this is a promise that appears sometimes very, very long. And this is why the states have such an important role to play because they have to put in place the legislation that protects our citizens over 40, 60 years, in fact, which is very, very long. And no private body can do that on its own. If we have a look in the past to the number of companies in the room, we were already existing in the past 40 years ago. It would be surprising that some of them have appeared, some of them have disappeared, and this is a very long promise. So it doesn't mean the private sector has not to provide a lot to respond to the question, but it means that it has to be carefully managed by governments in order to provide the framework I've heard many times you are looking for. It's also important to say that those pension schemes have a huge macroeconomic impact. Just to give you an example, in France, we have just obtained a recent study showing the macroeconomic impact of, for example, increasing public contributions. Of course, the direct impact is a decrease of the growth. If you reduce the pension levels, you have a decrease of the growth. The only one measure that appears to be positive is the increase of the age limit, which provide more people at work if the percentage of unemployment is not increasing too much. And also, it reduces the pension payments over a shorter period at the same pace that the longevity is increasing. So the first pillar, what are the available choices? As it has been presented very openly, there are systems which are more contribution funded and systems that are more tax funded. And the philosophies, implicit values behind that are equity or adequacy. The poverty risk, for example, is covered by the safety net provided by Pillar 1 if we are in a logic of a tax-funded system. So a choice has to be made by government to position itself, or to position the country, in fact the nation, on the scale of being more contribution-based, which rewards the workers, the good workers, I would say, which are contributing to a system, or to protect more the more, I would say, the poverty, to cover the poverty risk. And issues have to be tackled, of course, in designing the future features of the Pillar 1. So we have to face the life expectancy increase, which provides, and it has been already shown in many statistics that have been presented to you this morning, increase the old age dependency ratio. But at the same time, we have to face the financial crisis and the sensitivity to unemployment, which creates a potential hole of social contributions or tax revenues. And one major, I would say, discussion that should take place in the market on the first and second pillar is to know who bears the risk. And it has just been said by the previous presenter, so now insurers could take risks. It's right, but are you able to take all the risks? For sure, no. I don't believe insurers should take all the risks. There should be a sort of indexation of the benefits with indexation to the level of the health of the economy. And to do that, for the Pillar 1 or for the Pillar 2, you might choose different ways of doing. And there have been a lot of thinking all around Europe on how to do that. For example, for Pillar 1 system, you can choose to have notional accounts or individual accounts, unit-based accounts, and those units can be managed over time to cope with the real capacity of the state. So it can be done. Just to give you, I would say, a message, it's not done in France, for example. Huh? So there is a plan to do so, but it doesn't mean it's done. For the Pillar 2, it means to have more defined contribution plans, and it has been said already. If you want to keep a formula-based benefit plan or a defined benefit plan, it's meaning a promise based on a formula, it's become more and more difficult. And the reason for that is because there are less and less defined benefits. Now, if we have a look to the gross replacement rate, and those figures are, of course, before the promises made by the Greek government, we see that in Greece, the level of the gross replacement rate is particularly high compared to other countries. And the sustainability of those metrics might become more and more difficult over time. Not to say that there are, in a static vision, there are not a lot of differences between, I would say, the statistics on life expectancy at birth or at age 65. There are not a lot of differences in the percentage of working age population, but the dynamic is strongly different. We will have a look at that afterwards. So in order to be able to convince the population to make the jump into a new world by having more, I would say, Pillar 2 and Pillar 3 pension obligation or pension benefits, we need to consider that there are a lot of constraints and a lot of educational aspects that need to be discussed, and also over time. Because, first of all, there are a lot of key stakeholders to be, I would say, aligned in the same direction, with the same vision. And among them, the government, the regulators, in your country and outside of the country, have to be aligned. Trustees, if you have more and more systems with Pillar 2 professional pension funds, they will represent the employees and the employers, employers as well, and members and the intermediaries. But the most important and philosophical aspect is which dimension do we promote? Is it more equity, I mean equality among the members or among the citizens? Is it more adequacy? Do we have the means to cover those future benefits? Because I've seen, for example, targets of gross replacement rates of the system, but is it affordable from an economic point of view? What are the consequences on the growth, for example? Is it predictable? And this is important to say that nobody knows how is going to be the situation for the next 10 years. So it's more and more difficult to predict what is going to be the situation in 40 years. Efficiency and effectiveness, it's all about cost and administration cost of those systems. Is it effective? Does it provide the appropriate service considering the costs? And is it in the best interest? And whose best interest is it? For example, in the segmentation in 3 population, who is going to benefit from the intergenerational, I would say, effect? Well, who is going to pay for who? So pension reforms take place currently everywhere. And there are a lot of, I would say, incentive to do so, a lot of driver. So government have to operate under budget pressure. Employers, if they provide professional systems, have to deal with their balance sheet management. And employees and individuals discovering that the promises that have been provided to them for the past are not going to be able to cover in the future, are more and more incentivized to increase private savings. So the response we see on the market is not necessarily only unilateral. I mean, more and more Pillar 2 system or Pillar 3 system are hybrid systems, combining defined contribution and defined benefit. Defined contribution because it's supposedly a system that has no risk for an insurer or for a bank, but it does not cover the, I would say, personal needs of individuals. So they want to have a part of formula guaranteed in their system to be able not only to understand that they have, for example, made some savings their whole life, but also what would be the minimum they can be sure they will get in the end. Because the problem with the defined contribution is that it's totally indexed on the financial markets, and for that reason, it does not necessarily provide, I would say, the good feeling and the good appreciation by the users. And those aspects have to be taken into consideration in the way those systems are marketed, in the way those systems are presented to the citizens and to the beneficiaries. So a lot of reforms have already taken place in all countries. Some of those reforms are more parametric. A move in the age limits, a move in the contribution levels, a change in the early retirement pre-pension systems. Some of them are more structural. For example, the introduction of a funded second pillar, a move from DB to DC, align employees of the public and the private sector. It's all a matter of equity, but are we sure this is a good approach? Indexing the retirement age to life expectancy, pension calculation methods. So we can benefit from a lot of good examples from other countries. And it's not enough. A lot of other reforms are taking place everywhere. What is the most important in designing those reforms is to take time and to apply those reforms, to implement those reforms with the same timing that are the length of pension obligation. And the reason for that is that if you have, I would say, a harsh reaction of the citizen, they are not going to use your new systems at all. And you were talking about your current Pillar 2 system, because I understood there was a good system developed in 2002 for the sector, but money is not there. And if you have a look, for example, in France, on the same kind of system, people are not putting money in the system. They are not convinced. So it's not only a matter of designing, I would say, clever solutions. It's really a matter of assisting our citizens in buying in those systems. And if you have a look to the most successful reforms that have taken place, for example, in Europe, you will see that the strategic focus and the key challenges that have been faced by the country has been different over time. And that the horizon that has been managed is about 40 years. And this is probably the most difficult thing to do. And only a government helped by a strong industry can do that over time. And also, it was mentioned that the Netherlands is considered as a well-positioned country, but we have to recognize they started their journey a very long time ago. So structural reforms are creating a lot of challenges and opportunities for stakeholders. So key reforms are taking place in many countries on retirement and pension systems, on pension system for public servants, on pension schemes for employees. A lot of outcomes are expected, but also a lot of implications of those reforms have to be taken into account. I've just mentioned one on the macroeconomic impact. If we want to do something too quickly, we might destroy the growth that is necessary to sustain the system. This is also a reason why it has to take more than 20 years to put in place. So it means also that the governance of such reform needs to be apolitical. And this is something even more difficult to do. And there are clear opportunities for insurers to participate in that debate, to provide solutions, and to propose new legislations to the government, keeping in mind that we are talking about very long-term issues. Thank you very much.